So first of all, I'm really thankful to all of you to get together today here. And as you know, this is quite an important time for us. We start to collate various regular reports that we produce. And the first item on our agenda is really the Economic and Social Survey of Asia Pacific 2015. And in this context, it's really an year-end update. It's a tradition UN ESCAP has had, and this will eventually then lead into a more full-blown document which will be presented at our commission. But because there are frequent developments in the region and quite substantive one, the region gets influence from external developments, but also given its size and complexity, it has the potential to also impact the global economy. So the first thing probably we should look at is really what the key findings and messages of this report are. And in interest of time, I'd like to say the first one is really that Asia Pacific is actually slowing down, and it is slowing quite significantly, and I will cover in depth some of the issues related to that. Of course, as the global crisis emerged, Asia Pacific, which has driven, of course, the global economic growth, has been also impacted by the external demand, which has been quite weak. But over and above the external demand, this report talks about both the domestic and regional demand that has its influence on the regional growth. And of course, we have also in terms of the domestic demand, if you dissect it further, it's constrained by the trends in investment as well as structural barriers, both weak infrastructure and regulatory burdens in some countries. Also, the report goes into looking at the dynamics of the monetary policy response. Hamza, you're supposed to be here or there? Okay.
He's handling the...
Sorry. Okay, you'll handle that. Hamza, by the way, is the team leader of this report, and Ainul is heading the division. Sorry, I should have introduced you up front. So I asked Hamza, since I have my back, to actually use the pointer when I'm referring to the graphs to make it convenient. So the report also talks about the monetary policy responses, which are going to be quite complicated in the coming months. Countries will have to manage the pressures of the capital flow due to US monetary policy normalization and lower growth differential with the US. So you will hear a little more from me on that. And of course, we go a bit into the fiscal policy. Of course, with the growth scenario that I have talked up front, getting fiscal policy stances to be more in sync with what the situation at the fiscal level in an individual country is very important. And we do believe there is fiscal space around some countries at least, and they should definitely invoke that room for maneuverability that they have. Another key area that we have investigated in the report is really the private debt, because it's rising private debt, and that has clearly impacted the financing cost. Higher financing cost, as we know, leads to financial instability given the high corporate and household debt levels in some countries. This is another message of the report. Of course, there are a range of medium-term economic challenges that the region faces, and among them, the most important, I would say, that the region faces is how to transition towards more inclusiveness, competitiveness, and strengthening the productivity of the workers. And as you know, we have adopted sustainable development goals, so at the regional level, in line with the global direction, and we are hoping that sustainability and inclusiveness will receive a boost through that, and in turn promote more sustainable economic growth. So let's move to the action slides, what I would call after these big messages. What we have found is that the economic growth, and we are looking at the figures for 2015 and 2016, that economic growth remains on decline. And there are some trends in there. Growth in developing Asia and Pacific has been revised downwards since our previous year-end report. Growth estimate for 2015 is down to 4.5% from an earlier forecast of 4.9%. To me, what is more worrisome, that growth seems to have plateaued around 5% compared to an average of 9.4% growth between 2005 to 2007. And here Hamza will use the pointer to show you what is worrying us relative to 2015 and 2016. Is that while the declining trend had set in since the crisis, and if you look at the pre-crisis figures, our trend in the region has been very healthy, and the region was driving the global growth, that now what we are finding is that in addition to the trade factor that has been impacting the growth trend, that there are other elements which are also impacting. So Hamza, can you flash that, the red part of it? Can you can, okay, I can see it. So this downgrading that you see in the red line relative to the blue line really reinforces the point that there are factors other than the extra-regional trade or external trade. And we do believe this is also being prompted by the domestic demand weaknesses itself. With this, at an extreme remark one can make is that one perhaps has to start thinking whether Asia will continue to drive the global growth. Most likely not. It will be a contributor to the global weakness as we see right now. Of course, it depends on how fast advanced economies are going to grow, and we do see in the yellow line that there is a momentum that advanced countries seem to be picking up. The faster they do so, better. But the signs are that while growth estimates for United States are looking a little more encouraging, about 2.1% positive growth in 2015 and 2.4 in 2016 expectation. These are the figures of the US Fed. And Eurozone also is kind of gaining momentum, but the overall weaknesses remains. Japan seems to be still showing weak signs. So there is, of course, clearly an element of uncertainty of the global aggregate demand, which, of course, impacts the growth scenario. But as I said, it's not just the global demand, but now there are some additional factors which seem to be seeping in and getting more settled in there, which are more worrisome. The next slide, I'm going to not spend time going through each of the figures, but give you some big ticket directions that are important to keep in mind. I think most developed developing countries have seen their growth forecast downgraded by ESCAP. There has been a little adjustment in Russian Federation, and let me take Russian Federation first. For 2016, our forecast has been upgraded from it contracting by 1.6 to now contracting by half a percentage point. And this upgrading or better results on contraction, it's an awkward way of putting it, is not really an improvement in the country outlook. So we should not be misled by this improvement. It reflects the expectation that perhaps oil prices will remain stable in 2016 rather than fall, but it's hard to predict the scenario on our oil prices. And if they do stabilize, this will lead to stable rather than worsening prospects, and therefore the forecast is upgraded to only a moderate contraction rather than the strong contraction that we had assumed earlier. Another positive factor is that inflation is forecast to be lower in Russia, so monetary policy can be supportive. However, the fact remains that the economy continues to contract, primarily due to its commodity dependence. Let me also pick on India. It's got an interesting story. 2016, we originally were forecasting it to be 8.2%. It was really some national statistical adjustments that had occurred at that time. Our now estimate is 7.5%, as you'll see there. And for Indonesia, we are saying that 2016 has been adjusted from 5.8% to 5.3%. So forecasts downgrade in these two areas is based on our belief that our assessment is that there is a slower progress in reform policies after a good announcement after the elections and a lot of hope that people had. Indonesia is downgraded also due to the effects of the commodity dependence that it exhibits, with many of its commodities that it exports experiencing low prices also. Malaysia and Thailand are interesting cases for their own account. Malaysia, we have had to downgrade from 5.2% to 4.8%, and Thailand from 4% to 3.5% forecast, partly due to the impact of domestic demand, of high household debt, which impacts consumption. And we will cover this in the next slides a little more, so I won't go into details for now. China story is very much in the news, as you know, all over the place. 2016, the rebalancing impact is now manifesting itself in different ways. So there has been another revision from 2016 is expected to be 6.5% growth. It's of course, as I said, the rebalancing is a managed process to some extent. It's a controlled slowdown, but it's happening at a faster pace than most observers were hoping, although everybody was calling for rebalancing, and now that the rebalancing is occurring, there are of course, there's an element of nervousness which is seeping in some of the statistics. Slowing growth was a necessary condition at some point, and all the researchers and policymakers were arguing, even in the G20, rebalancing of China was a big topic, and now it's happened and taken us still by a surprise. So it has a strong knock-on effect on exporting economies in the region. I will cover that, but let me talk about Thailand a little bit because we are sitting out here, and Thailand is seeing some positive trends, clearly. The public investment is getting a little more buoyant, and also the tourism sector has gained momentum, and our forecast is actually quite a bit in line with the Bank of Thailand, but lower than the Fiscal Policy Office, which is about 3.8%. Let me move to the real storyline, which is gripping, as I said, everybody, which is the slowdown in the Chinese economy and its attendant manifestation in different indicators. Growth in China, of course, has slowed down not in one shot, but it's been happening over the recent quarters. Third quarter 2015 growth in China of 6.9% in inflation-adjusted terms was the slowest since the first quarter of 2009 when the process started. And of course, it's interrelated, rebalancing global crisis impact where the global demand got impacted. The slowdown in China has been, of course, driven by declining contribution of investment and also the composition of the investment, as well as net exports, as China is moving from goods to services-led dead economy, or manufacturing composition is going down also within its domestic production base. The slowdown is, of course, reflected in declining industrial output. A forward-looking indicator of this is the Purchasing Managers Index PMI, which has been below 50. That is contraction in orders since mid-2015. Indeed, November 2015 saw the lowest PMI indicator reading since August 2012. So the nervousness was captured by the market also. The decline in industrial production is caused by both low external demand, which we talked about, due to slow recovery in the advanced economies, but also what the point I made earlier, which is the main contribution of this year-end service is the low domestic demand due to slowing growth itself within the economy. Domestic investment has been especially slow in the important sectors, but particularly the real estate sector, with a large overhang of supply from previous construction. The slowdown in the final demand by China has large spillovers for exporting economies in the region. Most affected have been commodity exporting economies, with Indonesia and Malaysia being among those affected. Also affected have been exporters of manufactured goods, both of final products and intermediate goods. Those most linked to China in this respect are relatively high-income economies of Singapore, Thailand, Republic of Korea, and Taiwan, province of China. For example, in November 2015, exports from the Republic of Korea to China contracted by 6.8%, while non-oil exports from Singapore contracted in the third quarter by 7.5%. So you do see these trend lines which are depicting the various countries' growth of exports to China for some of these Asia-Pacific economies. And you can see that the slide is quite significant as it's emerging. Concerns about the impact of slowing Chinese demand on countries' growth as well as on the region has led to sharp falls in the Chinese stock market as well as stock markets in the region in recent months. And since the start of 2016, in January 2016, as of 11 January, the Chinese equity markets fell by 15%, erasing all of the market gains in 2015. The region's markets, as measured by the MSCI index, excluding Japan index, fell to their lowest level in the first week of January 2016 relative to the January 2011. While Chinese currency is managed, which we all know, and thus has fallen moderately, the outflow of capital from regional stock markets has been reflected in the currency market declines in the region. And of course, you can, of course, see this other set of graphs, which is the equity market performance for China and selected economies. And I will cover this in more detail in a minute. Let me get back to the question of the moderate recovery in advanced economies that are also affecting the region, given its export-led growth momentum. So apart from slowing demand in China, slow recovery in advanced economies is affecting exporting economies in the region directly. Global trade in 2015 is expected to show slowest expansion since 2009. And of course, it affects indirectly through re-exports from China too. So not only the exports of the countries are impacted because of what's happening to China as an exporter of our regional economy, but the re-exports that were going to China have also slowed down in terms of the intermediate goods and others that China manufactured and exported out. Let me now go into the domestic demand side. Domestic demand, as I've made the point, is not growing in a robust manner. So apart from extra-regional trade, growth slowdown in the region over the past few years has also been due to a slowing domestic demand. Slowing domestic demand in major economies translates into lower intra-regional exports for small exporting economies. Both investment and consumption has declined in a variety of economies since 2013. We look here in the graph, and Hamza will use the pointer to show you that the case studies that we have put out here, Malaysia, Russian Federation, Indonesia, and Thailand, and the years that we have are 2012 in green. In yellow, we have 2013, and 2014 is the red bar. In all countries, there has been a contraction in the contribution of the private consumption to economic growth. And you will see in some countries it's more steeper than others. The case in point, Thailand, from green, the longer bar, we are down to the red small one. So there has been a steep contraction there. And contribution to the fixed investment to economic growth is manifested by also the decline in the Russian Federation, which is contraction, and Thailand, where it's contracting. So now it will be clear to you why we had downward revisions to the Russian growth forecast and the Thailand, and even Malaysia, where it's quite steep decline in the contribution of the fixed investment to economic growth. These happen to be also consumption has been affected in some of these economies also due to high private debt and inflation. And Malaysia and Thailand are examples of economies in the region which share the problem of high household debt. It's greater than 50% of GDP. And high debt has arisen in such economies due to easy credit. For Russian Federation and Indonesia, consumption has been impacted by high inflation due to the falling currencies, and resolving the factors underlying the depreciation through strengthening macroeconomic fundamentals will be the way forward for promoting consumption, but the scenario there is a little dicey. Let me move to, in interest of time, to the next slide, which is about the inflationary trends. On this, suffice to say, there are really two stark positions here. There are countries in our sub-region which we don't need to worry about too much on inflation. For instance, East and North Asia, where it is forecast to continue to experience a very low inflation rate of about 1.4% in 2016. Southeast Asia and Pacific developing countries are also forecast to experience low rates of inflation of 3.1% and 4.3% respectively. But commodity producing exporting commodity, producing and exporting economies do have a sustained upward impact on inflation from falling commodity prices. And this, of course, includes the North and Central Asia sub-region, where there will be high rate of inflation, close to 8.7% in 2016, because, of course, of the difficulties posed by the decline in the oil prices and its impact on the currency. Let me say that, of course, this will create more complications in terms of the room for maneuverability to make adjustments. When you have high inflation, your room for maneuverability to ease monetary policy also, or to provide stimulus to aggregate demand, also reduces. Before we go further into that, let's spend a little more time on currency depreciation, which has accelerated due to, of course, the anticipation that grew as a result of the US monetary policy and normalization. And of course, the Chinese growth concerns are a second important phenomena that have cropped up along with the uncertainty of the monetary policy unwinding, and that has gripped the international policymakers and, of course, the investors that are making choices of where to invest money in. Exchange rates have depreciated due to general outflow of the portfolio capital in anticipation, but also the actual adjustment that occurred in December in the United States. This is, of course, also tied up to what led to the divergence in growth and interest rate prospects of many regional economies with those of the United States. Countries most affected are those with open capital markets and weak macroeconomic fundamentals, and it's the usual that I've been talking about, Russian Federation, but added to that is Turkey with capital account vulnerabilities, Indonesia and Malaysia, which have the commodity dependence. It's also due to weaker economic data from China, which we have talked about, and managed depreciation of their currency. And I've talked also already about the weak Chinese data. The devaluation of the Chinese currency has increased concern about the impact on exports of other competing countries. There's a big debate about the currency. Currency depreciation has also resulted because of some countries have encouraged currency weaknesses themselves due to concerns about export prospects, but also because of what's been happening in China and also competing regional economies. So everybody has to, of course, be competitive at the end of the day to promote their exports. Monetary policy, which is always a way out, is constrained in its ability to act by the capital outflow concerns, because the normal reaction is when you have capital outflows is to raise the interest rates. And we make a point in our report that monetary policy flexibility for countries has, of course, depended on country circumstances, but we make the point that we have to be very vigilant in our monetary policy stance. Because if we tighten the screws more, then we will hurt the growth prospects. So this is always a troubled area for the central bankers and the policy makers, because you have to weigh the pros and cons. We do believe that concerns about capital outflows should be managed by other tools, non-monetary policy related tools, what we call the also the macroprudential measures, and that really means that countries may have to rely more on increasing reserve requirements on foreign currency deposits, higher provisioning for foreign currency lending, and tightening consumer and mortgage lending than being more blunt on the interest rate itself. And there is room for maneuverability there on the interest rates as we see. Most economies have already lowered policy rates recently. Uh, Despite subdued growth and inflation outlook, some of them have anticipated, and it's hampered their further monetary easing, even if they have not adjusted. Countries more at risk of excessive outflows are, of course, the usual ones that have the weak macroeconomic fundamentals and substantial commodity dependence. And again, this group includes Russia, Malaysia, Indonesia, and few others. Now, I have to say in the story that we have captured here, particularly as I go further now into, I want to preface that we haven't been able to go more into the least developed countries and less developed countries of what I'm going to talk about further now because of the lack of data on the private debt. So I want to just preface that a little bit before I get into not the slide number 12, but a little further on. I think the special feature of this report, I would like to flag this, is really the private debt storyline that my colleagues have been able to bring out. US federal fund rates are expected to rise, and we know the sequence of the rise to some extent, which has been captured by the green bars perhaps on your right-hand side out here, which Hamza is already pointing to. Whether domestic interest rates will increase accordingly depends on country-specific factors, which I have talked about a little bit, but the usual indicators to watch out are the exchange rate, external debt asset prices, effectiveness of macroprudential measures, and et cetera, et cetera. So whether domestic interest rates in Asia-Pacific economies will increase accordingly depends on several country-specific factors. For instance, countries that have fixed exchange rate regimes will be more likely to raise rates compared with those that are pursuing flexible exchange rates or are willing to depreciate their currencies. Furthermore, rate hikes may not be needed if currency depreciation is expected to boost exports, but is unlikely to raise external account vulnerabilities through higher external debt burden, and lower asset prices are not expected to undermine private consumption and increase the risk of financial instability through rising loan defaults. Let me go into the private debt with this preface that I have talked about, because this is also interlinked on the pressures of the private debt. We do find that this phenomena is a very serious one within our region. Since the global financial crisis, and partly as a result of the expansionary and liquidity generating policies which were pursued by major advanced economies, and all the middle income countries that are in the G20 have been kind of talking about it, that they are faced with renewed risks. Household debt and corporate debt grew because of the excess liquidity in many Asia-Pacific countries, but countries with systemic significance in the global scheme of things. While sovereign debt may not have been the problem because it's been stable, between 2007 and 2014, non-financial private debt share as a share of GDP surged some 75 percentage points in China and 30 to 37 percentage points in Malaysia, the Republic of Korea, Thailand, and Turkey. While it is a common tendency for household debt to increase with rising income levels, the rapid pace of the growth of such debt raises concerns. Moreover, much of the household assets and debt is tied to the real estate sector, which we know is always vulnerable in these countries. So it, of course, makes the household very vulnerable to the fluctuation in housing prices or real property prices. In some countries, a disproportionate amount of debt is also held by households with low capacity to service the debt. Similarly, corporate debt has increased at a rapid pace. The risk is high for countries with relatively large short-term external liability as a share of foreign exchange reserves, including India, Indonesia, and Malaysia. Countries with large private external debt and low export earnings, which helps you service the private debt, are also at risk. External corporate debt as a percentage of exports is particularly high for Indonesia, Turkey, Russian Federation, around 50%, and for India, about 75%. So leveraging is pretty high in some of our countries. And I would say the figures in the report will show you that Indonesia and India tops on the leveraging. Rapid increases in private debt pose risks for financial stability, not only the corporate difficulties which manifest themselves into growth also, but it destabilizes financial sector, and it reinforces the need for effective supervision and regulation. Given likely increases in financing cost at a time when income growth is slowing, some balancing act is needed with attention to private sector's debt servicing capacity. Okay, we've talked a lot about corporate debt and household debt and monetary policy and others. Let me move to fiscal policy. There's a lot of talk, again, in G20 economies, which include Asia-Pacific economies also, that there's more room for maneuverability to stimulate aggregate demand from the window of the fiscal window. And we also make this point that more counter-cyclical and expansionary policy can be adopted in our region. Of course, you have to really look on a case-to-case basis this. And we are not at all advocating reckless movements. I think there is already an attempt, and I talked about Thailand trying to stimulate public investment. Thailand's has also taken some good steps like improving the tax policy and administration as needed. Thailand's new inherent tax is being introduced in 2016, which is a positive step. So the point I'm making is, even if you do not have, you have to create the fiscal space through tax measures in our region. Many in South Asia, of course, do not have the fiscal space, and they have to create the fiscal space by raising the tax GDP ratios, which have been stagnant, particularly in South Asia. Let's move to the last few slides, which are quite close to the heart of the debates in the United Nations. I think our biggest economic challenge that we face is that we basically have to revive economic growth in an effective manner. Now, the Asia-Pacific region has made tremendous progress in trying to promote Millennium Development Goals, to uplift our social indicators and so on and so forth. We have had the benefit of lifting millions of people out of extreme poverty, and some decent social progress has been made. We have been traditionally home to about 2/3 of the world's extreme poverty. So we can ill afford to have these gyrations that we have talked about, whether they have got to do with currency markets or stock markets that we are facing now, or for that matter, slowdown of the aggregate demand, whether it is got to do with external demand or domestic demand or intra-regional demand, I think our region has to be positioned in an effective way. And I would just say that what's important is that the countries move on structural reforms in a more substantive manner, and this is where we are lagging quite a bit. But also accompanying this structural reform has to be an effort to enhance competitiveness and labor productivity, which will augur well both for inclusivity and sustainability. So the last message is the 5 takeaways. A new normal of economic growth continues amidst weak global trade and China's slow growth. Asia-Pacific economies will need to look more towards domestic and regional demand revival. Fiscal policy, number 2 message, fiscal policy can tackle cyclical and long-term challenges and relieve pressure on monetary policy, which is going to be more difficult to manage if you want to also use monetary policy to ease, provided, of course, tax revenues are strengthened. Third message is that rapid increase in private debt call for vigilance, especially as financing costs are likely to increase in the region. Fourth message is that productivity growth should be accelerated and its benefit adequately shared with labor force. And our fifth and the last message is really the adoption of 2030 Agenda of Sustainable Development. It is not just about economic growth anymore. We live, of course, in the era of this sustainable development, and all the efforts of the United Nations, both at the global as well as the regional level, are tied to getting to promoting a sustainable development agenda, and that's what our regional commission is about.